Are you ready to unlock one of the most hidden concepts in ICT? In this video, I'm revealing the quarterly theory, which is a powerful framework that can change the way to analyze the markets. We will learn everything about quarterly theory, including types of quarterly cycles, timing strategies, and how it influences market behavior. Plus, I will break it all down with step-by-step examples to make it easy to apply. Stay tuned because this approach will help you avoid silly mistakes. Let's do it. So let's start about quarterly theory, what is it, about cycles, and step-by-step approach. What is it quarterly theory? Quarterly theory posits that financial markets exhibit recurring patterns aligned with quarterly periods. Traders analyze the cycles to anticipate market movements. But, however, ICT has criticized quarterly theory, suggesting it may not be reliable. Despite this, some traders find value in applying quarterly theory to these strategies. And this theory based on two types, AMDX or XAMD. I will tell you about this more detail after a few minutes later. If you are an intraday trader and you trade during a certain session, personally in my experience, this theory works great in zone of interest. It can be higher time frame following gap or order block. And now let's talk about the cycles more detail. There is 4 phases of quarterly cycle. This strategy based on cycles. Each quarter can be broken down into 4 distinct phases, which helps traders understand how price moves during a quarterly period. There is only 2 types of quarterly theory, AMDX and XAMD. And right now let's talk about AMDX formation. This cycle looks like power of 3. It is based on accumulation, manipulation, and distribution. And there is 4th cycle, which can be continuationally or reversal. And during accumulation cycle, it is a period of consolidation, where positions are built. The next cycle is manipulation, a phase involving false moves or judo swing to mislead traders. And usually during this cycle there is a sip of liquidity. And in distribution cycle, which is a phase where positions are unloaded, often leading to significant price movements. And X cycle. This phase either continues the previous trend or reverse it. Let's look at this example. This is Nasdaq 100 90-minute cycles. The first cycle looks like accumulation positions. During this cycle, the price was in consolidation. If we can identify the first cycle, it will help us identify the model, AMDX or XAMD. If the first cycle looks like consolidation, it tells us that this is an AMDX model, and the next cycle will be manipulation. And during the manipulation cycle, the price swept liquidity twice, and as you can see, what formed market structure shift. During this cycle, you can open position after market structure shift or open position during distribution cycle. And XAMD model. In this example, price start moving from X cycle. In this example, during X cycle, the price can continue to move in the direction of the trend or reverse. Usually, if there is a reversal, then market structure shift is formed during the X cycle. Let's look at this example. During first cycle, the price continued to move in the direction of the trend, and it tells us that this looks like XAMD model. And as you can see on the second cycle, price more moving in consolidation. And after the consolidation cycle, the price swept liquidity and formed market structure shift during the manipulation cycle. And you can open an order after market structure shift. And during distribution cycle, the price continued to move in the direction of the trend. And now let's talk about timing and type of cycles. There is 4 types of quarters: yearly, monthly, weekly, daily, and 90-minute cycles. The yearly quarters is divided into 4 quarters, each comprising 3 months. First quarter from January to March, second quarter from April to June, the third quarter from July to September, and the fourth quarter from October to December. If we talk about monthly quarters, each month is to split into 4 weeks. And weekly quarters, the trading week is divided into 4 days, typically Monday through Tuesday with Friday, having a distinct role. Daily quarters. A trading day is segmented into 4 6-hour periods, aligning with major global trading session. First quarter is Asian session, the second quarter is London session, third quarter New York AM session, and fourth quarter is New York PM session. And as for me, the most important cycle, which is 90-minute cycles. Each 6 hours quarter of the trading day is further divided into 4 90-minute segments, resulting in the following structure. Honestly, I watch only 90-minute cycles. I don't watch on daily quarters, weekly, monthly or yearly because I trade during day. because I'm intraday trader. And I can recommend you indicators that show all these quarters. And in order not to mark the cycles on the chart, I can advise you indicators that I personally use. And first indicator, which is 19-minute cycles. Honestly, I advise you to remove extra cycles. That is, let's say if you trade during New York AM session, then leave only 4 cycles that are formed during the session. And there is another indicator, day quarterly theory, but this indicator shows at the bottom of the chart. Honestly, for me it's not quite comfortable, but it's up to you. And as you can see, in settings you can choose what cycles you need to watch. And the lowest box, which is weekly, higher, which is daily, and the highest, which is only 90-minute cycles. And now let's talk about how to trade this quarterly theory. I talk how I personally use like an intraday trader. First of all, it's important to combine the strategy with ICT concept. Personal, I pay attention to SMT divergence on 50-minute time frame or 5-minute time frame. And I also marked a point of interest. It can be order block on higher time frame or fair volume gap. And it's important to look liquidity. It can be previous daily, monthly or weekly liquidity. So okay, and the first step, which is top-down analysis before session. I start my top-down analysis from daily time frame. In this example, you can see that below there is fair volume gaps on daily time frame. I stretch premium discount zone that identify most potential area where price can to pullback. And I think that price can to do pullback in fair volume gap inside discount zone. And step 2, we mark on 4-hour time frame, on 1-hour time frame, the potential area where price can to pullback. It can be order block or fair volume gap. And soon we'll start New York AM session, and right now price inside fair volume gap in 4-hour. And it tells me that it'd be better if I to find short position during New York AM session. And step 3 is identify the quarter, AMDX or XAMD phase. During session, I pay attention to the first cycle, because the first cycle speaks of the course of the price or is formed AMDX or XAMD model. For example, if I see that price is in consolidation for 90 minutes, I understand that this looks like AMDX model, so the next cycle will be a manipulation. Or if price for 90 minutes cycle makes a trend or market structure shift, it tells me that this looks like X cycle, and it tells me that this is XAMD model. Let's look at this example. On the right, the horizontal line is the beginning of the New York AM session, which is Nasdaq 100 asset. And let's pay attention to the first cycle, which looks like accumulation, and it tells me that this looks like AMDX model. It means that the next cycle will be manipulation. And what happens next? And as you can see on Nasdaq 100, the price manipulate swing. And when the price sweep liquidity during session, I always look at the divergence, because when liquidity gap formed, usually very often there is a divergence between two assets. And as you can see in this example, you can notice that on Nasdaq there is a swing manipulation, and on S&P 500 no manipulation. And this confirms the divergence on 50-minute time frame. And as you can see at 9:30, the New York AM session began, and immediately was formed market structure shift. Here it was possible to open a market order immediately after the market structure shift formation. And before I will show you real examples, let's summarize this theory a little bit. And finally, by combining quarterly theory cycles with ICT approach, you create a more precise and structured approach to market timing. Understand where you in the cycle, track institutional price levels, and use ICT concept to enhance your probability of success. Always remember to adjust to changing market conditions and manage risk carefully. And now let's talk about real examples. Okay, this is EUR/USD pair. Now let's wait first cycle that identify which model right now formed. Now I switched on 5-minute time frames to see more detail this. As you can see, first cycle looks like more accumulation. And if first cycle looks like accumulation, it means that right now forming AMDX model. And it means that the next cycle is manipulation. And right now I need to identify potential area when price can reverse. First of all, I see that price right now in fair volume gap, and below there is order block. And logically now I need to wait signs of reversal. So okay, the manipulation cycle is over, and logically right now should be distribution cycle. And as you can see, price created market structure shift, and I think I can open an order. So okay, the profit was achieved, and right now let's watch this example again. And as you can see, it looks like AMDX model. First cycle was accumulation, the second manipulation. During manipulation cycle was a lot of liquidity, and already during distribution cycle, price creates signs of reversal, and in X cycle, which is looks like continuationally, price achieved might take profit. And this is another example, which is Nasdaq 100. Below there is point of interest for our follow volume gap. And logically we should to identify signs of reversal, and right now let's look at the cycles. And as you can see, it looks like X cycle. Price create market structure shift, and it means that right now is a reversal cycle. And it tells us that right now is the XAMD model. It means that the next cycle will be accumulation, then manipulation, and only after manipulation, distribution cycle. If we know that the next cycle will accumulation, it tells us that the market will be in consolidation. And during the accumulation and manipulation cycle, I don't advise you to trading, because it happens either to sip of liquidity, or the market simply doesn't give the opportunity to catch a good movement. So okay, as you can see, accumulation cycle was created, and right now we'll start manipulation cycle. Logically, you can trade the manipulation cycle if the price, sip of liquidity, and formed market structure shift. So let's look at this example. As you can see, was formed sip of liquidity. And since we knew that during the manipulation cycle is often happen liquidity grab, we didn't trade. And if we had opened a position after the formation of market structure shift in the first cycle, I got a stop loss. So now the liquidity grab was formed, and we need to wait for the market structure shift formation. Okay, as you can see, market structure shift was created. Now I need to mark order block that to find potential area where I can to put stop loss. Logically, market structure shift will be here, but it is not clear formation. So okay, and now let's open an order. Profit was achieved, and right now let's look at this example again. On the first cycle was formed market structure shift formation, and this tells us that it's formed like the X cycle, which means reversal or continuationally. If you manage to determine the first cycle, it already tells us what model will be formed, XAMD or AMDX. And after we determine the first cycle ourselves, we already understand whether it is worth opening a position now. If we open a position after the formation of market structure shift, I will get a stop loss, because during the formation of manipulation cycle, there was a swing manipulation. Okay, and since we determine the cycles themselves, we have already completely built the opening position, since we opened the position already on the distribution cycle, and that's why this theory helps to avoid stupid mistakes. Now that you understand the quarterly theory, you're equipped with a deeper insight into market timing and cycles. Use this knowledge to refine your strategy and gain an edge in your trading. Drop a comment below if you have any questions or want to see more topics like this. Thanks for watching, and see you again. Trust the process.